Short-term rentals can produce 2 to 4 times the monthly income of a comparable long-term rental. Now, that's the sales pitch, and it's true sometimes. But what the short-term rental gurus on YouTube are not telling you is that STRs is not a passive investing. It's a small hospitality business that you're running inside a house that you just happen to own. Now, it's an operational load, real market risk, and regulatory exposure that can change your entire investment overnight. In 2026, the landscape is shifting fast. Idaho just became the friendliest STR regulatory environment in the country with their House Bill 583. Meanwhile, cities like Galveston and metros like Austin, Las Vegas, they're all dealing with severe oversupply that is crushing occupancy for individual hosts. The STR playbook that worked in 2021, it's not working in 2026. In the next 20 to 30 minutes, I'm going to walk you through the complete STR strategy, what it actually is, the DSCR products that finance it, the market selection framework, the best and worst markets right now, the operational math, and how to know if STR fits your situation. I'm Robert with Open Lane Funding. Let's get into it. Short-term rental investing is buying residential properties and renting it by the night, week, or the month, typically through platforms like Airbnb and Vrbo, to travelers and short-stay guests. Rentals and 30 days or less, fully furnished, guest ready between every booking. 3 things that separate STR from every other rental strategy is 1, revenue per night, not per month. You're not locking in $2,000 a month on a 12-month lease. You're pricing $250 a night, filling calendar dates, and letting demand determine your value or your revenue. On a good property in a good market, that translates to gross annual income 2 to 4 times what the same property would produce as a long-term rental on a bad property in a bad market. It means empty calendar dates and negative cash flow. 2, it's a business. This is not an investment. Every long-term rental is an investment property. STRs are small hospitality businesses. Guest communication, cleaning turnovers, pricing optimization, listing management, review responses. You have to have emergency maintenance, restocking supplies. You either do this work yourself or you pay somebody 20 to 30% of your gross revenue to do it for you. Either way, this is not passive. 3, revenue depends on market, product, and execution simultaneously. With the long-term rental, if the market is decent and rent is set at market, you get paid. With an STR, you need the market to have the travel demand, your property to be the right product for that demand, and your operational execution to keep occupancy and reviews high. Break any one of those 3 legs and the strategy fails. The yield premium on an STR is real. Here's what it actually looks like. A typical 3-bedroom home in a decent tourism market, rented for long term, might produce about $2,200 per month. That's $26,400 in gross rent. The same property operated as an STR in the same market might produce $50,000 to $80,000 in gross annual revenue, roughly 2 to 3 times higher. In premium coastal or mountain markets, sometimes 4 times higher. But gross revenue is not what is not what you keep. STR carries operating costs that LTRs simply don't have. You have cleaning fees between every guest, $75 to $200 per turnover, and you're often about 40 to 100 turnovers per year. Utilities you pay, not the tenant: electric, water, gas, internet, streaming, roughly about $300 to about $500 a month. Consumable supplies: toilet paper, paper towels, soap, coffee. Restock every turnover, $30 to $50 per turn. Furnishings, wear and tear replacement. You have furniture depreciation and replacement runs about 5 to 8% of revenue. Platform fees, Airbnb takes about 3 to 15% depending upon the host plan. Verbo commissions similar. You have management, property management if hired, which is about 20 to 30% of gross bookings for full service, or 10 to 15% for half service, where you still coordinate the cleanings. Now, the STR specific insurance, it doubles or triples the standard landlord policy premiums. HOA fees, permits, licensing, lodging taxes vary by market. When you They also have higher maintenance frequency. Guests are going to be harder on properties than long-term tenants. When you strip all of that out, net cash flow on an STR is typically 30 to 50% of gross revenue. So that $60,000 gross STR might actually only make you $20,000 to $30,000 after everything. Still meaningful, better than what the LTR would be. That nets you about $18,000 after expenses, but the gap is smaller, and the top line comparison suggests that the work required to get there is actually dramatically higher, and everybody looks over that. Here's where 2026 gets interesting. STR-specific DSCR loan products. Traditional DSCR loans qualify you based on the long-term rent projections. You want to run the property as an STR, but the lender is underwriting it as if it's a $2,200 a month long-term rental. You pay for the flexibility. That works, but you're leaving money on the table. STR-specific DSCR products qualify you on projected short-term rental revenue instead. The lenders uses AirDNAs or similar data source to project realistic gross Airbnb revenue for the specific property. Subtract a standard operating expense ratio, typically 40 to 50%, and that calculates DSCR based on that net income. Typical STR DSCR terms are going to be minimum about the ratio about 1 to about 1.25. Some even require 1.5. Down payments, you're looking about 20 to 25%. Some lenders are at 15% on really strong files. Credit score about 660. Minimum average is going to be about 700 to 720, while 740 to 760 you start unlocking the best rates. Rates are going to be in that 6% to about 8% range, roughly about 20 to 25 basis points, sometimes 50 points above the standard DSCRs. The reserves are going to require about 3 to 6 months of the payment, interest, taxes, and insurance and HOA dues. LLC ownership is allowed by most, and matter of fact, is required by most. 30-year fixed terms. There are some that have interest-only periods, but you really only want to get interest-only periods if you want to sell the property within those time periods. Why this matters. On the projected STR revenue of $60,000 gross versus the $24,000, $26,000 LTR gross, the STR DSCR product actually qualifies you for a substantially larger loan or a substantially better rate at the same loan size. Now, getting the right loan product matched to your operational strategy is often the difference between the deal working and the deal not working. So watch out for two things. First, some lenders will reduce the projected revenue by 20 to 30% as a haircut for market risk. Second, most short-term DSCR products require you to demonstrate STR experience or management contract with an experienced operator before they will fund. First-time STR investors sometimes get pushed to LTR-based qualification with a plan to refinance after 12 months of actual booking history. Now, comment STR Playbook below, and I'll send you the market screening worksheet plus the best and worst STR markets ranked by occupancy and revenue. And subscribe and follow, because next Wednesday I'm going to be doing a deep dive on wholesaling, the strategy for investors who want to work real estate but do not want to own property. This is where more STRs fails than any other reason. It's the wrong market. So let's fix that. 5 variables that determine whether an STR market is investable in 2026. Variable 1, occupancy rate. Look for a market average of 55% or higher for annual occupancy. Below 45% and you're fighting oversupply. Above 65% and you have real market demand. Do not average across the year without checking seasonality. A market at 70% in June through September and 25% through from October through April has a 47.5% annual average, but you'll starve for 8 months out of the year. The variable 2, supply trend. It is the number of active listings in the market is growing, stable, or shrinking. Growing supply at more than 10% year over year is a warning sign. More competitors chasing the same demand pool means occupancy is going to drop and the pricing pressure is going to build. Variable 3, ADR, average daily rate. You want that to be above $150 per night minimum for the strategy to make sense on a financed property. ADR under 125 is usually a deal breaker unless the property is bought at an unusual discount. Variable 4, regulation. What is the current STR regulatory environment? Is a permit required? Are permits still available? Are daily caps in place? Are owner occupancy requirements enforced? Are restrictions being debated? Buying into a market where regulation is tightening is one of the fastest ways to lose an investment. I personally have known individuals who have bought into a situation like that, and then now they have to flip the property into a long-term rental to make less money. Variable 5, demand drivers. What actually brings visitors to this market? Tourism, business travel, medical, seasonal events, universities, sports. You want multiple demand drivers, not just one. A single driver market, one ski resort, one lake, one convention center becomes a ghost town when that driver softens. Now, make sure you run all 5 variables before you make an offer. If a market fails 2 or more, you need to walk away. There are 400 plus investable STR markets in the US right now. You do not need to force one marginal one to work. I get a drink of water. Now let's look at where the data is showing STR winners and losers right now. All numbers, hypothetical for education, sourced from AirDNA, or Air ROI, and Airbiotics for 2026 data sets. The top tier winners right now are markets in 2026 are listed below. We got Sedona, Arizona, has a 52% occupancy, $431 ADR, 52,500 TTM average revenue. The premium demand, you have limited supply, a mature tourism market. Charleston, South Carolina, 56% occupancy, $420 ADR, 48,000 TTM revenue. Historic tourism, plus growing business travel. You have Breckenridge, Colorado, which is 42% occupancy, $574 ADR, 46,700 TTM revenue. Ski market, ultra premium pricing. Gatlinburg, Tennessee, 48% occupancy, 367 ADR, 40,600 TTM revenue. Smoky Mountain volume tourism. Destin, Florida, 44% occupancy, 462 ADR, 39,200 TTM revenue. Now, emerging markets in 2026. You have Port Arthur, Texas, Abilene, Texas, downtown St. Paul, Minnesota, Charleston, West Virginia, Springfield, Illinois, Lake Charles, Louisiana, Montgomery, Alabama, Akron, Ohio, Lebanon, Pennsylvania, Jackson, Mississippi. These aren't glamorous markets, but they're markets where the median prices are above 150 to 280,000 ADRs, and their ADRs are 130 to 180. Occupancy is sitting at 55 to 80%, and the market cap math actually pencils. Lodgify's 2026 cap rate analyst puts Jackson, Mississippi at a 15.95 and Abilene, Texas at 14.01. Now, the markets that are in serious trouble, we've already hit some of these, which are Galveston, Texas. The Air DNA shows a 43% occupancy across roughly 5,900 units to about 6,300 units that are active listings. The Air ROI reports 34.8% occupancy. The Airbiotics reports 47% occupancy with a 251 ADR. Local real estate professionals are describing the market as oversaturated. The number of registered STRs nearly doubled between 21 and 24 and to almost 5,000 units, and profit margins have thinned dramatically. January occupancy in Galveston drops to 18%. A property owner without a strong pricing strategy and off-season plan is bleeding cash for a third of the year. Austin, Texas, 10,500 listings at a 14.8% occupancy. Median annual revenue for these is $11,471. Las Vegas has 17,624 listings at 4.9% occupancy. Rev pair has $7 per typical listing, generating about $2,500 per year against a $2,000 mortgage. Severe forced selling pressure here. You have Miami and Broward County, Florida. There's 16,822 listings at 8.2% occupancy. Median annual revenue is sitting at $10,800. Nashville, Tennessee, the occupancy has declined here 8 to 14 percentage points from 2021 to 2022 peaks. Now, still workable, but not the layup it used to be. The pattern is clear. The pandemic era boom markets got flooded with supply. Occupancy has collapsed. Individual host revenue collapsed with it. Buying in these markets in 2026 without a compelling angle, deep discounts, extraordinary product, or exclusive niche is buying into negative cash flow. Now, let me talk about the regulatory story that matters most to my Pacific Northwest audience. Idaho House Bill 583. On March 16th, 2026, Idaho Governor Brad Little signed House Bill 583 into law. It took effect July 1st, 2026. This is the most sweeping state-level STR preemption laws passed anywhere in the country. Here's what it does. Cities and counties in Idaho can no longer require STR-specific licenses, permits, or fees, impose daily caps on how many nights per year a property can be rented, require owner occupancy as a condition of operation, impose STR-specific parking or structural requirements, restrict STR density or proximity between listings. What cities can still do, though? They can still collect lodging taxes, enforce noise ordinance that apply to all residential properties, require basic registration, not permits, and enforce health and safety codes that apply uniformly. Why this matters for investors. Boise, Coeur d'Alene, and Sun Valley previously had some of the most restrictive STR regulations in the state. In fact, Coeur d'Alene right now is working through to repealing all of those to make sure that they're compliant with the law. Those restrictions are now preempted. North Idaho and Coeur d'Alene markets specifically just became one of the most STR-friendly regulatory environments in the western United States. The math I'm seeing on Coeur d'Alene STR properties post as House Bill 583 has 55 to 65% annual occupancy in most submarkets. The ADR is about 250 to 350 depending upon lake proximity, strong summer demand May through September, with meaningful winter demand December through March for the CD8 resort and area ski access. This is a market to look at seriously if you're building your first STR or expanding a portfolio in 2026. Now, the counterpart that I want to be honest about is regulatory environments can change. House Bill 583 is law today, but a future legislator could amend or repeal it. Underwrite your deals so that it pencils at even under a current moderately less favorable regulatory scenario. I apologize. Let me put the numbers on a full STR deal, all hypothetical for illustration purposes only. Now, say you buy a 3-bedroom, 2-bath home in a solid tourism market, Coeur d'Alene, Tennessee, or similar tier 1 markets. Purchase price, you're looking at $450,000. We're going to say 25% down, which is about $112,500. The STR DSCR loan, you're looking at $337,500 at 7.5% on a 30-year fixed. Furnishing budget is $25,000. Total capital in, you're about $145,000, which includes your closing cost. Projected gross revenue year 1 assumes 55% annual occupancy, 275 ADR, blended across the seasons. Nights booked at 55%, times 365 days. You're looking at 201 nights. Right about the gross booking revenue. Let's say 201 nights times the 275 ADR that we calculated. You're looking at about $55,275. Now, operating expenses year 1. Your mortgage principal and interest on a $337,500 mortgage at 7.5% is $2,361 per month, which is about $28,332 a year. Property taxes at 0.8%, you're looking at $3,600 per year. STR-specific insurance, you're looking at $2,400 per year. Utilities, electric, water, gas, internet, streaming, you're looking at $4,800 a year. Cleaning fees pass through to the guest, but not always fully covered. So net cost about $1,500 a year. Consumables and restocking, $2,000 a year. Airbnb platform fees, 3% to the host, is about $1,660 per year. Property management, assume half service at 12%. You're looking at $6,633 per year. Maintenance reserve, 8% of the revenue. You have $4,422 per year. Furniture depreciation reserves, 5% of revenue, $2,764 per year. Operational expenses is at $58,111 per year. That makes your net cash flow for year 1 negative $2,800. So yes, that's slightly negative in year 1, which is why so many STR investors get their pants pulled down. But here's the total return picture. Cash flow is negative $2,800. Principal buy down is $3,800. Appreciation at 3.5%, you're looking at $15,700. Depreciation tax savings, you're looking about $3,600. So in total, year 1 return is actually about $20,300. Your return on your $145,000 is about 14%. The return on your investment, your ROI. By year 3, you are managing well and the market holds. Occupancy improves to 60 to 65%. Your ADR grows as well to 3 to 4%. Your revenue climbs to $65 to $70,000. And based on, you got cash flow flips to $8,000 to $12,000 positive. The STR investor who survives year 1 gets rewarded in year 3. The investor who buys in Galveston at the same purchase price economics is looking at a 40% occupancy in a saturated market. Gross revenue drops to $38,000. Operating expenses stay largely the same. The property loses $15,000 to $20,000 in year 1 and is unlikely to recover. Now, market selection is the entire game. Now, the part that almost no STR YouTuber talks about is what running an STR actually looks like week to week. If you self-manage, you need to respond to guest inquiries within 60 minutes, 7 days a week, or your listing loses ranking. Coordinate cleaner between every checkout and every check-in, often same-day turnovers. You have restock supplies, sometimes weekly, handle emergencies, locked out guests at 11 a.m., broken AC in July, plumbing issues at 6 a.m. Update pricing every few days based on demand, competitor pricing, and events. Photograph and updated listing seasonally. Respond to every guest review, both positive and negative. Track and remit lodging taxes, sometimes monthly, sometimes quarterly. Managing cleaning and maintenance staff. Realistic self-management time commitment is about 10 to 20 hours per week per property, sometimes less, sometimes weeks. Some weeks can be catastrophically more. Now, if you hire a property manager, they handle all of the above. They do typically take about 20 to 30% of your gross revenue booking, however. Your role becomes more of a financial monitoring, capital decisions, and quarterly review of the performance. The realistic time constraint is about 2 to 4 hours per month per property. The full service PM haircut on a property management haircut is about on a $55,000 gross revenue is about $11,000 to $16,000 per year. That's real. It kills cash flow in year one, but it also gets you back your time and lets you scale beyond one property. Half service management likely to evolve right around that 10 to 15% coverage ratio or which covers marketing and guest messaging, but leaves the cleaning, maintenance, restocking, and pricing to you. That's the middle option. AI assisted management options like Tidy has a 3.9% of bookings are new and interesting for cost conscious operators willing to manage more themselves. Which model to pick? If you own 1 to 2 STRs and live within 30 minutes of the property, self-manage your half service. If you own 3 plus STRs or you're out of the market, make sure you hire full service or you're going to be burnt out in 18 months. 3 mistakes I see that kill STR investments in 2026. Mistake 1, buying in oversaturated markets because the ADR looks great. Galveston has $250 ADR. It also has 47 to about 40 to 47% occupancy across nearly 6,000 listings. Some segments of the market are drowning. ADR without occupancy context is meaningless. Revenue equals ADR times occupancy. Both variables, get both variables in your underwriting right away. Mistake 2, under budgeting operating expenses. New STR investors run projections at 20 to 25% expense ratios. Reality is you're actually closer to about 40 to 55% for well-run STRs. Higher premium for premium markets with high cost management. If your deal doesn't pencil at a 50% expense ratio, don't buy it. Mistake 3, assuming today's regulatory environment holds forever. Regulations can change. Idaho's House Bill 583 was a landlord unlock. Similar bills in California, New York, Denver, and dozens of cities have gone the opposite direction. So make sure you underwrite your deal to survive a scenario where regulations tighten by 30 to 50%. If it doesn't survive that, you're buying a regulatory optionality, not a real investment. Now, STR is the right strategy for you if you have an entrepreneurial mindset. This is the small business, not passive investment. If an operational load turns you off, go run and buy and hold. If you're operationally competent or willing to pay for someone who is, great. STR investors either love the operational game or write off big management checks to escape it. You can absorb year one negative cash flow. The most STRs in 2026 financed at market rates run negative or break even in year one. So if you need positive cash flow immediately, go buy an LTR in a landlord-friendly state. You want yield concentration on fewer properties. Owning 3 well-run STRs at $10K a year net cash flow beats owning 10 LTRs at $2K a year each on a total return without spreading yourself thin across 10 management relationships. STR is not for you if you want a passive income. Choose buy and hold instead. You can't absorb 3 to 6 months of negative cash flow if the occupancy drops. Your market has severe oversupplies signals like Galveston, Vegas, Miami, Austin at their current levels. If you have no operational bandwidth and you refuse to pay somebody 25% plus management fees. You're allergic to reading guest reviews and responding to complaints professionally. There's a lot of people who have that last one have issues. This is a big part. You have to read these reviews and you have to be very professional as you respond to them. There's no cut and dry. You can't be thick. You have to be very thick skinned. You have to be very polite and respectful. Otherwise, you're going to lose listings. Bottom line is this: STR is a legitimate wealth building strategy in 2026. It's not a passive one, and it's not universal. The right market, right product, right financing, right operational commitment. Get all four right. STR outperforms almost every other real estate strategy on cash return. Get any of the four wrong, and STR will lose money faster than any other real estate strategy. Comment STR playbook below for the screening worksheet if you're evaluating a specific STR property, especially in Idaho, where the House Bill 583 just changed the game, or if you want a DSCR quote using STR-specific revenue projections. Call or text the number that's on my website, which is 208-215-9936, or you can go to my website and book a call at openlanefunding.com. I'm Robert with Open Lane Funding. I'll see everybody else on Monday. Thank you.